This is the Net Group Investments Insights podcast, where one or more of our experts explores a variety of views and insights that investors care about.
Hi everyone and welcome. I'm Mansoor Naka, investment analyst at Net Group Investments, and today I'm joined by Iain Power, the CIO of Truffle Asset Management and one of the 4 portfolio managers on the Net Group Investments Balance Fund. Welcome, Iain.
Hi Mansoor, thanks for the invite.
Iain, just to set the scene, we're halfway through the year and already so much has happened that has impacted markets both on the up and downside. However, the fund that you and your team manage on behalf of our clients has virtually sailed through this period of volatility without so much as a scratch. If I look at performance to the end of May, net of fees, the fund has delivered around 13.4% and about 20% over the 1-year period, placing it at the very top of the pack amongst its peers. And of course, over the longer term, you've returned just over 11% per annum since inception for clients, which I think has been a fantastic outcome in a tough market. But coming back to more recent performance, can you briefly unpack how you and your team have managed to achieve this level of performance over the past couple of months, given market developments?
Mansoor, I think that's right. I think it has been a good year for us, and it's funny how fast things change. Leading up to the back end of 2024, I think after the expectation of Trump's victory, and I think the unfounded expectation of some of the potential positives to the US economy, it's very, very interesting how lots of that optimism has unwound. With a real sense of reality and perhaps trepidation and maybe even more recently a little bit of fear, given the extent of US policy decisions, their actions and the implications on the global economy. But I think if we sort of step back and just take a look at the landscape at the end of last year, you had US assets which were really priced for perfection. We certainly were cautioning our clients last year that the concentrated positions that were evident in many of these US assets were a risk, given the fact that, we thought that there was just too much good news priced into many of those assets. On top of the fact that lots of the growth that we've been seeing come out of the US has really been a debt-fueled growth bubble on the back of increasing deficits. At a time where the size of deficits that they're running, typically you only see that level of government intervention when you've got deep economic recessions and, they're looking to stabilize the economy. So, the long and short of it is that US assets were very expensive, the dollar very, very expensive, and lots of the other assets outside of MSCI world, when you strip out the US, were looking particularly attractive. And I think that's a view that we took with the fund, and really looking for good businesses, solid businesses. Some of these are global businesses which were trading at massive discounts to their US counterparts, with just as good earnings prospects. And that margin of safety, I think, is the key really when one builds a portfolio, to make sure that there is a significant amount of runway between the value of the share and the price that the market is pricing it, because that in itself gives investors some measure of protection when and if volatility strikes the market. And I think, as you said, 2025 has been a year where, even though we're only halfway through the year, it feels really like a lifetime. And we've had lots of shocks, we've had lots of unpredictability and lots of volatility. And I think it's that margin of safety, with the underweight towards, some of the big US shares, certainly a big underweight towards the US dollar, which on a trade-weighted basis this year has been absolutely smashed, has really stood the fund in good stead and enabled it to withstand lots of this volatility and, protect investors at the same time as, helping through our process to generate the real returns that our clients need over time.
Indeed, if I look at the positioning of the fund, there's very few things that have gone against you. You've been in the right places. Thanks for that, Iain. If I think back, the fund was very defensively positioned in 2023. And although you've changed positioning to adapt to the market since then, as you've mentioned, having interacted with you over the past few years, I know your views have very much been consistent on how things could unfold. Give us an update of your thoughts around markets today and where you see opportunities going forward.
And so I think the fund, if we look at risk asset exposure, we've probably got still reasonable risk asset exposure, but when you drill under the hood, the fund is pretty defensively positioned. And we have over a period been reducing duration in our portfolios as we've had lower and lower rates from a domestic point of view. At the same time, our offshore exposure has been consistent, where we've been underweighting the US, underweighting the dollar, and have been building positions and had meaningful positions in some of these unloved big European companies, particularly in the defense sector, as well as in the staples sector, which have really, really done well this year. And that's really just been predicated on the fact that the long-term expected returns from the US market, particularly US large cap stocks, is certainly not rewarding investors for the risk that they are taking. And hence, that has been our position, and it's been consistent. And in a very short period of time, perhaps catalyzed by, some more fiscal stimulus coming through in Europe, perhaps some more expenditure on defense, and some of the fears and the worries around the sustainability of US exceptionalism have started to see a flow of funds away from the US, which we think will increasingly accelerate and probably continue to push the dollar down from a level right now which is very, very expensive. So our portfolio is structured fairly defensively, not to say that we don't have some higher risk positions in there, but they are offset by defensive positioning, in addition to the fact that we are certainly taking advantage of our full offshore allowance. And the way we've structured the portfolio really helps us manage volatility, as investors will have seen this year, where there's been some big hits to some of the markets and spaces. And, the fund has managed to weather that relatively unscathed. And I think it's because of that defensive makeup of the portfolio and the way we've tried to hedge some of these risks.
Thank you for your insights and analysis today, Iain. It's been enlightening to hear how you and your team have navigated the complexities of the market to deliver such impressive results. Your strategies and foresight have clearly paid off, and it's reassuring to know that the fund is in such capable hands. I look forward to seeing how the fund performs in the coming months and years. Thank you again for joining us, and to our listeners, thank you for tuning in. Until next time, stay informed and stay invested.
Thanks, Mansur.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.